Going on, ladies and gentlemen? Let me know if you can hear me okay. It's our first stream back here in a little while. There are some major issues going on in the housing market, in the job market, and we're basically looking at a recession here, whether people want to admit it or not. There's way too much happening to deny it. The prices of lumber have collapsed to pre-pandemic levels. That means that home builders are no longer building as many new homes as they once were. So watching lumber prices is a bit of a canary in the coal mine. It's very similar to what we saw during the '08 crash. Let me know how the audio is doing. I am turning it down a little bit. What's going on, Daniel, Tyler? It's good to see you. Dank, Nicholas. Welcome back, ladies and gentlemen. This one is a little blurry, but we are basically looking here that the Bureau of Labor Statistics is going to revise down the United States jobs numbers for the 12 months ending in March of 2025. This means under Joe Biden. So under the Joe Biden administration, they overstated jobs by almost 1 million jobs. So the preliminary estimate, as you can see, was much higher, and they are going to be removing 550 to 950,000 jobs. That's a huge reduction and a huge downward revision. The largest that we've seen in 15 years. 15 years. Okay? That is a total cut over the last 2 years of 1.5 million jobs, folks. 1.5 million jobs. And every single month this year, we've seen another downward revision. So far, we've seen 461,000 downward revisions this year. And for last year, because the Bureau of Labor Statistics had somebody in place that was lying consistently about the jobs numbers, which Donald Trump, of course, fired and replaced with somebody competent because he got rid of the DEI hire, they've been able to estimate that they were overstating the jobs numbers by almost 1 million for the last 12 months ending in March of 2025. So from March of 24 through 25 under the Biden administration, the Bureau of Labor Statistics lied and said that there was almost 1 million jobs more than there actually were. You can see how this is a big deal. Gold right now. Kobesai Letter put out this great post. Gold is telling the future. The S&P 500 is in one of the strongest bull runs that we've seen in decades and is up massively over the last 5 months, about 9.32%. Meanwhile, gold's year to date, 9.35% over the last over the year to date here for the S&P 500. But gold, it is up 37%. 37% compared to the 9.3% for the S&P 500. Gold is absolutely crushing stocks in a bull market. Ladies and gentlemen, this right here screams that banks and institutions are extremely concerned. They are incredibly worried. Gold prices are now up 100% compared to the 67% gain in the S&P 500 since 2023. So if back in 2022 and 23, we've been telling you on this channel, gold and silver are where it's at. These are, because of the inflationary pressures and the macroeconomic and geopolitical worries that we cover on this channel, are going to be incredibly strong. When silver was still at $17, $18 an ounce, we were telling you guys how good of a buy it was. It's currently at $40 an ounce for silver. Gold is now at all-time highs at 3,600, and despite what we've seen with artificial intelligence, this is been the biggest breakthrough in technology since the inception of the internet and even Android phones and Apple iPhones. Stocks are heavily lagging gold. And the historical relationship between the two is incredible. All right. Since 2023, S&P is up 66%. Gold is up almost 100%, outperforming the S&P 500 in a massive bull run, folks. This cannot be understated, the importance of this. This is the historical relationship between gold and the S&P. When gold is a safe haven, historically, like bonds, which rises in terms of uncertainty and equity market weakness, we saw a recent trend shift in 2020. That one's kind of small. It's hard for you guys to see, so let me switch it up here. And the shift is that even more so, gold and silver are much more heavily of interest to these large firms as the annual deficit nears $2 trillion and the government is issuing more debt. The supply of United States treasuries is growing and bond prices are falling. This makes bonds less attractive, and gold is the safe haven. Platinum is also up massively. Silver, we are looking very good in the precious metals markets. And you can see here, for the first time since 1996, gold holdings as a percentage of foreign reserves have exceeded the U.S. Treasury's holdings as a percentage of foreign reserves. This has not happened since 1996 for a reason. Because we are entering a period of stagflation, where the economy is stagnant and inflation is increasing. So right now, we told you guys that gold was going to 3,500, 3,600. At this point, it's looking like gold is about to hit $4,000 before people know it. It's looking like silver is likely to hit $50 an ounce sometime in the next year. Now, again, this is not financial advice, and you should hire your own financial advisor. This is information for you to take, learn from, and make your own deductions. A big indicator here is the fact that mortgage rates are dropping and yields have increased. The average 30-year fixed mortgage rate today is 6.29%. And the same day of last year, it was 6.35%. So it's down a few basis points, but the 10-year Treasury yield is over 4% with a spread of 222 basis points. So here we're looking at the lows, the highs here, and the difference over 1 day, 1 week, 1 month, and 1 year. The 15-year fixed is down 0.25%. And even jumbo loans and adjustable rate mortgages are down 0.62%, which is quite significant, especially if people expect that we're going to see a reduction in interest rates in the future. There is one thing that people need to keep in mind. A reduction in interest rates by the Federal Reserve does not equate to a reduction in mortgage rates. It does not. There is massive arbitrage there by the banks and the mortgage companies. Okay, and back in the 2000s, we already saw this happen. When mortgage rates were in the 4%, when mortgage rates were in the 6%, interest rates were in the 4%. So even still, just because the Federal Reserve might cut and is likely to cut interest rates here in September, that does not mean that mortgage rates are going to follow anytime soon. The banks are going to price them to what they believe is going to allow them to beat inflation. And if they believe that inflation is rising and the economy is stagnating, stagflation, even though the Federal Reserve cuts rates, does not guarantee in any way that mortgage rates are going to come down. So this is not exactly going to be great for the housing market. Let's put it that way. Paul Andrew, I hear you, my friend. There are going to be some crazy things happening. For example, like with Hycroft Mining Corporation, HYMC stock ticker. That company is looking so good right now, and they have had a significant increase in their percentage of their stock price in the last few months, especially. U.S. underemployment. Okay, underemployment means people that are not able to find a full-time job, so they're forced to find part-time work. Okay, millions of Americans have either given up entirely on the job search or can only work part-time or are working in the gig economy, Uber Eats, DoorDash, part-time jobs. This is soon to be 10%. And this is something we have not seen since 2008, folks. This is something we have not seen since the global financial crisis. Now, this June jobs report that we just saw was revised lower by another 27,000 jobs. This is for non-farm jobs, month over month net change. This is the first negative month since the scamdemic. I'm going to turn down my audio just a little bit because I'm noticing some feedback there that might be a little high for some people, but let me know if you need me to adjust it. It's our first stream back in a couple of weeks since we've kind of revamped the studio here. So again, this is the first negative month we've seen since early 2021. And even still, going back all the way through March of 2024, under the Joe Biden administration, we're finding out now that they're basically revising downwards jobs under Joe Biden into the beginning of Donald Trump's administration by almost 1 million jobs. So that means that they overstated. They claimed that there was 1 million jobs more than there actually were. And the June jobs report has now been revised lower by a total of 160,000 jobs. That is much more than the initially reported gain of 147,000 jobs. So that's like a net deficit there of over 300,000. We thought that they had gained 147,000, but in reality, in June, we lost 160,000. So you can see here why there's a difference of 300,000 right there. So look at this. May and June jobs report revised lower by a combined 280,000 jobs. Every single jobs report in 2025 has been revised lower aside from July. We are looking at a recession, folks, whether you'd like to admit it. Here's the thing. Those people and other folks that are making over 6 figures every year are not feeling this. And some people are very blessed, thankfully, and they don't really see this. They don't really feel this as much as, you know, the rest of the middle class and the lower classes do. That is potentially a serious issue, but the majority of Americans do see what's going on here. Now, the odds of a September 17th rate cut are at 100%. That is what banks are pricing in. They went from not fully pricing in a 25 basis point cut to increasingly calling for a 50 basis point cut. And this is a major shift due to the jobs numbers that we're seeing. And Jerome Powell has been consistently late, and this is more proof that yet again Jerome Powell is absolutely, unequivocally late in reducing interest rates as far as the economy is concerned. But because it's stagnating, we are going to see stagflation, an increase in inflation, while the economy remains flat. So we see Challenger data here. Challenger report announced job cuts from January 2020 through August of 2025. So the entirety of the Joe Biden administration and the beginning of the Donald Trump administration. Year-to-date job cuts surged to 892,362, the highest year-to-date total since the 2020 scamdemic. That is up 66% compared to the year prior. So there's not been an August total that exceeded 85,000 job cuts since 2008. So we have not had an August this bad in the economy since 2008. That should give you a little bit of an indication of the actual strength of the average American worker. You might be above that, you might be below that. I'm not talking about you specifically. I'm talking about the average, the median American worker. The United States has more unemployed people than job openings for the first time since April of 2021. This is a huge, huge problem here. 7.18 million job openings for 7.24 million unemployed people. And not every one of those unemployed persons is qualified for one of those job openings. So there are more people that are unemployed than there are job openings for the first time since April of 2021. And again, I already talked to you guys about this. The Bureau of Labor Statistics will be revising the U.S. job numbers downwards heavily by almost 1 million for the last year of the Joe Biden administration. Because they lied, as they love to lie, over and over again. Benchmark revision, as you can see here, National Current Employment Statistics, March 2024 through March 2025. That is negative 818,000 jobs, or total loss of private jobs of 819,000. Some of the most heavily seen, some of the most heavily lost jobs are in manufacturing, negative 115,000. Trade, transportation, and utilities, negative 104,000. Retail trade, negative 129,000. Professional and business services, negative 358,000 jobs. Leisure and hospitality, negative 150,000. These numbers are incredible, incredibly massive, and we're likely to top that here in just the next few days. Rate cuts here, and because of the changes and revisions in these jobs, are almost a certainty. It's not because inflation is down, but because the labor market has gotten so much worse. There are so many more people now that are underemployed and unemployed that even though core CPI inflation is over 3%, the deteriorating labor market is going to force the Federal Reserve to cut regardless. And that means that the economy is stagnant and inflation will increase further. So when inflation increases further, what happens? Gold, silver, precious metals, safe havens rise massively. Market-based inflation expectations over the next 5 to 10 years is what you're seeing here. They've been moving higher, and this is the reason why more institutions are buying gold. The markets have come to realize that the Fed's inflation target of 2% is nowhere in sight. Nowhere in sight right now. And that, in my opinion, is an incredibly bullish case for gold and silver. Again, we're already seeing silver at $40 an ounce. When we were first telling you guys about this 2-3 years ago, that inflation is not going away, that it's going to increase, it was at $17 an ounce. That is over a 120% gain. Same thing with gold. Gold is up massively over the last 3 years. Mortgage applications are down, even though I just told you guys and showed you guys, ladies and gentlemen, that interest rates are down for mortgages than they were last year. The actual applications for mortgages have decreased by 34% from pre-pandemic levels. You can see here, this is pre-pandemic here. And the last time, mortgage demand is 34% below pre-pandemic norms and 55% below the peak. This is lower than the crash that we saw in 2008 and 2012. Going way back here in 2007, 2008, 2009, 2010, the numbers were at this blue line. Right here, right around 2009, 2010 as well. And then they dropped to 170 mortgage applications, right? 170,000. Seasonally adjusted purchase applications, 200,000, 172,000, etc. And what we're seeing now is they're ranging between 128,000 to 150,000. The most recent peak we saw was 181,000, which was barely touching the bottom of what we saw in 2010, 11, 12, 13, 14, 15, 16, etc. This is much worse than what we saw in the collapse of 2008. We are basically back to the early and mid-90s housing crisis once again. Paul Andrews says, check out Vegas tourism, my friend. There's plenty of channels that are already doing that. You guys can look up. There's nobody in Vegas that does not have a ton of cash on them, because there are very few people actually going to Vegas right now. But that, I digress. This right here, even though we had rate cuts last year, and we're about to have rate cuts again, there is no discernible increase in home buyer demand back to normal levels. So the housing market's problem is very clear. It's not interest rates, it is prices. And until sellers are forced to reduce their prices even further, the demand is going to stay low. Look at this differential here. The differential between 20-25 percentage versus 24 and 23, it is higher slightly. But going back to 22, 21, 20, 2019, 2018, This is down 20% from 2022, almost 40% from 2021, and 35% from pre-pandemic in 2019. 31% lower than 2018. So until prices in the housing market come down another 20 to 25% and mortgage rates come down to 5%, buyers are going to continue to sit on the sidelines. And sellers, those that are forced to sell and have to move or unable to afford their homes, are going to have to make huge concessions. The bifurcation in the housing market, ladies and gentlemen, is huge. That means that it's greatly segregated. In places like up north and parts of the Midwest, where there is very little new home construction and where there is very tight availability, housing prices remain steady. But down in the South and in the West and in the Southeast, you're seeing greater and greater decreases in the housing market prices. We're talking Texas, Florida, Idaho, Las Vegas, Arizona, Colorado, etc., where there's a lot of new construction over the last 15 years. There is a much greater drop in home prices, and that is also being obfuscated. Those home prices are actually lower than what you're actually seeing because new home builders are giving away huge concessions. The housing price is staying the same, but they're giving away $50,000, $75,000, $150,000 in rate buydowns, so that instead of paying 6.5% or 6.1% interest for the next 30 years, you only have to pay 4% or 3%. These are new home builder tactics that they're using to continue to sell the price of the house here, but in reality, their profits are down here because of the amount of money that they're giving to buyers. So a buyer, for example, who's selling for $600,000 an existing home that's not a brand new house, thinks that they're in line with the housing market because new home sellers are selling similar houses for $600,000. The reality is, though, the existing home buyer might be giving away $10,000 in closing costs that they're paying for. The home seller might be giving away $10,000 in closing costs for the home buyer. But a new home seller, right, Pulte Homes, all these others, are still selling that house for $600,000, but they're giving away $100,000 or more in concessions, in rate buydowns, so that you have to pay less every month. And that's the only way that a lot of people can actually afford a house. Look at this is new single-family houses sold in the United States. Look at the rates we're at now in 2025. This is similar to what we saw before the scamdemic, similar to what we saw ever briefly in 2016, going way back to 2008. We are at the same level we were halfway through the housing crash in 2008. This is a big deal because what we saw here in 2020 with this blip in 2020 and 2021 that caused housing prices to increase so dramatically over the last 4 years was a farce. It doesn't make any sense because people were receiving so much financial assistance and so much financial aid, and there was so many handouts going out to homeowners that couldn't afford it because people weren't just getting foreclosed upon in 2021, 22, and 23. They were receiving deferments up to a year, year and a half, where they didn't have to pay their mortgage. See, Jesus Serpa says, I've been stacking gold and silver. It went up, but honestly, with all this money printing, it seems to make more sense to buy more gold and silver. Not FOMO, but it's where your money seems to be the safest. And banks and such are agreeing with you. Doug says, shit's been crazy for some time now. Definitely prices on homes are way too high. I would hate to have to buy now. You know? Jesus says, yeah, I'm no longer trying to buy a home. I saved up $30,000. I make almost $100K a year on my own and can't afford a house here in Vegas. I'll continue to rent, I guess. Also been stacking gold and silver. Cheers, my friends. Cheers. You're figuring it out. People are starting to open their eyes and realize what makes sense. Let's see, Ryan here says, I have less bills. I make $90,000 more a year than I did when I bought my house in 2011. And I wouldn't be able to afford my house right now if I had to buy it today. Sad stuff. And I have a credit score over 800 and it still wouldn't help. You're right, my friend. The unaffordability in housing is insane. The fact that you, Ryan, make $90,000 a year more than you made when you bought your house in 2011, and you wouldn't even qualify to buy that house today, shows you just how out of reach it is for the majority of Americans. And sellers are going to have to reduce their prices in a big, big way in order to be able to sell their house nowadays. And it's going to happen. They're going to be forced. It's going to be, people die and they give their homes to their children who can't take care of it or have to pay the homeowners back taxes that are in arrears due to the senior freezes and such. You know, people have to move for jobs, or they're unwilling to rent it. There's a lot of reasons why people have to sell their home, and it's going to happen. These housing prices are going to come down in the majority of the United States. Check this out. Goldman Sachs now is expecting gold to hit $4,000 an ounce by the middle of 2026. $4,000 an ounce. We already hit $3,600 this week, an all-time high. Gold prices have nearly doubled in the last 3 years. That's right. And silver prices have more than doubled in the last 3 years. This, my friends, this is something huge that I don't see anybody talking about on YouTube. What you're looking at here, all these massive numbers, is treasury bills. 4-week treasury bills, short-term bills being auctioned by the United States. And the United States just had the largest short-term auction in history. What we're seeing here is yield curve control. Yield curve control, folks. This is basically what Japan has been doing in buying back their own bills, in basically pulling off a Weimar Republic situation. The United States government spends more money than it collects in taxes, and it borrows it by selling these IOUs called treasuries that you see here, right here on my side. Right, we're talking billions and trillions of dollars worth of treasuries. And their promises. Investors lend the U.S. government money in exchange for the government to pay them back with interest in the future. This is how we fund Social Security, this is how we fund defense spending, and so on. So we've got short-term bills that are less than a year, medium-term that are 2 to 10 years, and then long-term bonds that are 20 to 30 years. And the United States usually spreads the borrowing across all three of these buckets. But because some of them mature quickly and some come due in a decade, the mix spreads out risk and stabilizes funding. But right now, the United States is leaning very heavily on these short-term bills because they're cheaper today. So imagine choosing between a 30-year fixed mortgage rate at 7% versus an adjustable rate that resets every month at 4.2. Treasury pick the adjustable mortgage at 4.2 because the strategy saves money in the long run. But it creates something called rollover risk, where bills mature very quickly. This means the government has to constantly refinance. And if rates fall, that's good. But if rates rise, then we see some massive pain. So the yield curve is basically just a graph. Take a look at it here. Short-term yields are very high because the Treasury is flooding the market with them. And long-term yields are lower because the Treasury is buying back 10 to 30-year bonds to reduce their supply. And that is artificial flattening of the yield curve. This is yield curve control. And this influences almost everything in the economy. Mortgages, debt for companies, corporations, car loans, etc. So if there's an unnatural bend to the yield curve here, it basically ripples into the rest of the financial markets and your household budgets. And investors here offered $271 billion 271 billion for these. The Treasury accepted 93 billion. So the bid to cover ratio for this is 2.9 times. That is 3 times more demand than supply. So there is 300% more demand for these short-term yields than there is for supply. And the winning interest rate was 4.175%. So 81% of the bids were filled, and investors hopped in because there is strong concentrated demand. Everyone wanted them at about the same price. We're talking pension funds, money market funds, banks, direct bidders, asset managers. So if the Treasury adjusts quickly to manage the cash balance in the Treasury General account, right? The bank account for the United States Treasury. It's Uncle Sam's checking account. That's where they hold tax revenues, and that's how they spend money and cash from these debt auctions. If that balance falls too low, the Treasury has to issue more bills. And if it rises too high, they issue fewer bills. But again, the problem is the rollover risk. The bills mature very, very quickly, and they have to refinance them constantly. So they have to buy back these bonds. Look at the amounts of Treasury buybacks. Sorry for the shitty quality of the Bloomberg chart here, but I'll explain it to you in case you're not watching or in case it's a little too blurry for you. So they sell the short-term bills and raise cash. Then they use that cash in a bit of a Ponzi to buy back the 10-year and the 30-year bonds that are already in circulation. And that reduces the supply on the long end. And when the supply falls, bond prices rise. And when bond prices rise, yields fall. That is bad for long-term bondholders. It means that the Treasury is purposely pushing down long-term borrowing costs. And they almost require inflation in order to do this to pay down the government debt. But it's bad for you as a consumer because it increases your mortgage costs, your student loan costs, corporate financing and borrowing costs, anything that's linked to long-term interest rates. Check this out. Money market funds. Look at how huge the amounts of investment that's going on here is. We're talking giant investment vehicles that hold trillions of dollars in safe assets. And right now they manage about $7.5 trillion. And they're pouring into these bills. We're seeing a massive reduction in the reverse repo facility right now. The reverse repo is down from a high of $2.5 trillion 2 years ago to only $20 billion today. The reverse repo rates today were $20 billion. They were tiny. Let me go back here. Let me see if I can pull that up here for you guys. This is our Discord, the think tank. This is the automatic think tank repo fetcher. Let's take a look at the amounts. The reverse repo operations today was only $20.9 billion, down from $2.5 trillion 2 years ago. We're looking at a 75% reduction compared to last week's average. 70% down from the 30-day average of 41, and 137% reduction down from the 60-day average in the reverse repo. These are some incredibly high numbers that we're seeing here. Let me get back to my other picture. So, way. Look at how high when all these money managers you see here, Fidelity, Vanguard, BlackRock, JP Morgan, Goldman, they're moving out of the overnight reverse repo. And that's the Fed's overnight savings account. Because they're moving into these instead. Because there's a higher yield curve control going on right now. And if the RRP is paying 5.3 and these bills are paying 5.35, that 0.05% on trillions of dollars is enough to send them fleeing over here on a global scale. And then we're seeing them move heavily into stable coins as too right now. They're really heavily moving into stable coins and cryptocurrencies as we speak, because there's over $160 billion in stable coins right now, and that's more than a lot of foreign governments have, right? So every time there's a new token minted, there's more demand for treasury bills. So crypto right now is directly financing the United States government debt. And this creates a level of fragility that if stable coins face a redemption, right? So if some of these firms take out a lot from these stable coins, or they get hacked, or there's a freeze, or regulatory changes, billions of treasury bills could be dumped instantaneously. And what maturities would be the ones to crash first? The shortest ones. The same bills that the Treasury relies on the most. Here we go. Beautiful chart of the Fed reverse repo usage that we were just talking about. RRP balances are at lows that we have not seen since before the scamdemic. We were at a high of $2.5 trillion just a couple years ago. And the quarter end always brings tension where they hop up. You see this higher number, the end of the quarter, 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 etc. Doesn't seem like that's the case anymore, because the Fed right now is running QT, and they're letting the bonds mature without reinvesting them, adding more long-term debt back into the market, and the Treasury is offsetting this by issuing more bills and retiring long bonds. So bills auctions tailing weak. It could tail weak demand and force yields even higher. This is not good for the bond market. Right now is one time in history where I personally think that having bonds is an absolutely terrible idea. It's owning these sorts of bills and bonds. I personally believe that there are much better investments out there, especially in private equity. For example, right now, you can own a part of Lit Exchange, an upcoming stock and crypto brokerage that we are creating. So far, retail investors have invested over $1.1 million in just the last few months in the company here. And when the company IPOs in the next several years, you would then have the opportunity to potentially sell your investment for significant profit. Now, of course, there is risk in that, and that's a couple years, 2-3 years out or so in the making. But if you're not retiring in the next few years, that might be potentially a very good investment. But of course, there are high risks with anything in the market, including that. Same with gold and silver. Gold and silver are up over 100% in the last couple of years, and that tells you a lot. Those are much better investments, in my opinion, now than the bond market would be. In cryptocurrencies, a lot of stable coins are currently looking much, much sexier. So, ladies and gentlemen, you need to do yourself a favor and go look into Lit Exchange, because this is the first time that a unicorn startup stock and crypto brokerage firm is actually giving you this opportunity, because this has never happened in the history of the world. So I will leave you with that. I will go to it for you right now, ever so briefly. You can see what a lot of investors are currently saying about the company, why they chose to invest in Lit Exchange. Our syndicate lead, Nicholas Butorak: I chose to invest in Lit Exchange because I firmly believe in their mission as well as their position to disrupt the financial markets industry of $3.6 trillion per year. A stock and crypto broker that is for and by the retail investor is a welcomed addition to a marketplace of investment tools that are consolidating by the year into larger and larger brokerages that have become too disconnected from the needs of their customer base. This is our chance to be a part of history, investing in a company that prioritizes transparency and proper price discovery of equities. At Lit Exchange, we are the customer, not the product. That is the truth, because right now, other payment for order flow brokerages like Robinhood, Webull, Schwab, etc., you are not the customer, you are the product. Wholesalers, market makers like Citadel and Virtue, they are the customer. They're the ones that pay Robinhood. They're the ones that pay Webull. They're the ones that pay Schwab. You are just the product. So your bid-ask spreads are worse. Your commissions are worse. And even though you don't see how much you're paying, it's baked into the numbers. You're getting worse bid and ask spreads, and your trades are being routed through dark pools, meaning that your stocks and your trades are being front run, and you're actually losing money on your investments in compared to if they were actually processed in lit exchanges. The reason lit exchange is called that as a brokerage is because it will be exclusively routing orders automatically to lit markets, like the New York Stock Exchange, like the NASDAQ, opposed to routing them directly to Citadel and Virtue and other market makers like Wolverine, Susquehanna, and State Street that can front run your trades, hide them in a dark pool, take 30 days to process them, fail to deliver, and then roll that over in perpetuity to make sure that your stocks lose money while theirs make money. That is the arbitrage that you're dealing with high frequency trading algorithms, market makers, and payment for order flow brokerages. So far, as you can see, over 500 retail investors have invested over $1.1 million in lit exchange. And this is the first time in the history of the world that any company has actually given you the opportunity as an upcoming stock and crypto brokerage to own equity in the firm before its launch and before its IPO. This has never been done before. It is 100% legal under the Jobs Act of 2012. Regulation CF stands for Regulation Crowdfunding via the SEC, the Securities Exchange Commission. You can find our SEC disclosures on the SEC Edgar website, linked directly from the link in the side in the chat and in the comments below, folks. Go ahead and take a look at that and learn a lot more about the company. Do your due diligence. On that note, I wish you peace and wealth. You know what, Comanzo, real quick, I'll be happy to answer your question. Would you say, considering the cup and handle with silver, along with the GSR being out of whack, that $200 per ounce of silver is possible? My friend, regarding to silver, $200 per ounce is possible. However, if we were to see $200 per ounce on silver anytime soon, we would be looking at a complete destruction of the global economy. The United States dollar, the fiat currencies, this massive project and game that the Federal Reserve started back when they disconnected the fiat from gold and from gold as a gold-backed currency, would collapse economies around the world. There would be massive amounts of world hunger, people dying. It would be absolutely tragic and sad. And I do not want to see silver at $200 an ounce anytime soon because of the destruction that it would lead to. Or more so, the destruction would lead to $200 an ounce of silver, right? The amount of people that would be homeless and unable to eat and dying, it would be incredibly sad, I hate to say. But in the long term, sadly, I think that $200 an ounce for silver is inevitable. And I'm talking over the course of like years and years and years. I'm not talking anytime soon. But as of right now, $50 an ounce for silver next year, I would not be surprised. $4,000 an ounce, maybe even $4,500 an ounce for gold sometime next year, I would not be surprised in the slightest. Ladies and gentlemen, I wish you peace and wealth. Have a beautiful rest of your day. Have an incredible weekend. Cheers, my friends. If you know, you know. Share this with somebody that you care about. Share this with somebody that you love, that would actually take a moment or take some time to listen. Listen in the car, listen while they're working out, listen while they're in the shower, whatever. This is important, and nobody in the government is going to tell you this shit because they do not want you to know. Cheers, my friends.